we've been getting from our viewers.
Okay, so the first question, and by far the most popular this week, is all about the US Federal Reserve cutting rates. And the question is this because of fears of a recession?
Well, if anything, the risk of recession has actually been falling, according to the New York Fed's own recession probability indicator, although this did give a false alert through much of 2024. You see, the real problem for the Fed is that the labour market is starting to deteriorate, but it's difficult to identify a clear pattern because of the distortions created by AI. The Fed probably actually shouldn't be cutting rates based on the performance of the equity market over the last 12 months, but there are sufficient uncertainties in the jobs market and stresses in the funding markets to allow policymakers a bit of leeway. But it is unlikely that they're cutting rates because they think a recession is imminent.
So next up, and kind of related to what we've just talked about, the question is, will rate cuts fuel another leg higher in risk assets?
Now, obviously, rate cuts helps particularly with sentiment, but it's not just the cost of capital that matters. It's also the availability of capital. If interest rates fall, but longer dated yields rise, then the benefit of lower rates could be fleeting. On their own, low rates do not fuel market rallies, and this was perfectly illustrated in 2008 when rates were rapidly cut and yet the equity markets continued to crash throughout the end of that year.
And the final question, and this is a big one, is will the Fed restart QE?
Well, first off, what is QE? QE, or quantitative easing, is generally thought of as the systematic buying of bonds by the Federal Reserve. Now, expectations for QE have been increasing because of recent funding issues and the creep higher in those longer dated yields. One of the main causes of concern is the size of the US government refinancing bill and the potential stresses from rising interest costs. Some form of QE or QE light is expected to prevent stresses rebuilding through 2026. Okay, that's it for this week, but before I close, please remember that none of this is investment advice. It's for education and engagement purposes only, and it's to help you with your own research. When investing, understand your own risk tolerance, time horizon, and investment objectives. And then invest accordingly.